Hey everyone, it's Colleen, the Preparedness Pro. I have got a really unique situation for you today for our show. I have got someone that can help us with financial preparedness who is like minded, who is a prepper like the rest of us, and does things in a very strategic and practical way. And he applies that to the world of finances as well. Kim Allen is our guest, and he grew up in a rural Northwest Ohio area on a farm in a stockyard with several siblings. His childhood was spent with his parents prioritizing cultural experiences, and they hosted exchange students almost every year. So it's no wonder that at 16, Kim became an exchange student himself in Venezuela and Colombia. And he just really immersed himself in the Spanish language and the Latin culture. And then after high school, he served a mission for the LDS Church in Buenos Aires, Argentina, attended college, married his wife, and they have three children. They've been in Ohio. He was an entrepreneur before he became the financial guru that he is. He was a very successful entrepreneur. They both had businesses, he and his wife, and sold those. And as the industry changed, they sold their businesses to just larger e-commerce companies. That's who they ended up with. Since 2008, though, he's worked as a retirement advisor and an insurance agent and the owner of several financial planning companies. And he specializes in helping families to preserve their legacy and protect their assets, which is what we want to do in financial preparedness. His companies, Legacy Group Planning and Legacy Group Wealth Management, they are in the top 2% of financial and wealth planning firms in the United States. So we are uniquely blessed today to have such what am I trying to say here? I'll edit it out later. To have such a wealth of knowledge for us, and someone who also believes he loves ham radio, off-road jeeping, food storage, hunting, and knife making. So he's a true prepper in every sense of the word. He just happens to really have the financial preparedness down pat. So you're going to discover a very unique approach to preparedness, and you're going to understand why fixed index annuities might be your financial bug out bag in market chaos. So we're gonna look at that. Let's go ahead and go into this, Kim. Again, thank you so much for being with us.
Absolutely. It's a joy to be here, Colleen, and love everything that you're about and the message you're trying to spread.
Thank you very much. Well, I love the message that you're trying to spread too, and that's why I wanted to have you on, because I get asked all the time by people to be on my podcast, and I've been asked by a couple of retirement planners to be on the podcast, but I kept knowing, nope, I've got Kim Allen. Kim Allen would be great to be on my show. So I'm glad you said yes.
Well,
So you have a journey from farm life to financial planning. That's kind of fascinating if you think about it. How did growing up in rural Ohio and even doing your business in rural Ohio, how did that shape your approach to preparedness and financial security?
Well, one thing, I learned a lot of lessons on the family farm. I was privileged to grow up with my grandparents around me. Of course, my parents are still very actively involved in things. My grandparents are gone, but I certainly learned a lot from them. I remember my grandfather telling me as we were doing work on the farm, Kim, if you don't keep it simple, people will get hurt. And that's a lesson that's stuck with me my entire life. And I believe that same principle should apply to the financial world. If we don't keep things simple and easy to understand, people are going to have trouble making the right decisions and will probably end up hurting themselves.
Yeah, that's definitely true. In fact, I've been doing some research because of my job. I do a lot of research in the insurance industry, and you're an insurance agent. And the statistic was pretty startling that 92% of customers do not understand the insurance that they have. And you go into a great deal of work in educating them. And that's one of the reasons why they trust you as an advisor.
Absolutely. Yeah, we spend a lot of resources in just trying to educate people about the troubled waters on the horizon, things that they can do to prepare themselves for what's coming. I
Yeah,
believe
we're going
that,
to talk about that for sure today.
yeah, that education is critical in order to make, sound decisions.
Now, you experienced life in third world nations as an exchange student. Did those international experiences influence how you view financial stability and preparedness at all?
Certainly, and to the credit of the people who live in those countries and in those circumstances, we don't even realize. Most of us don't realize how blessed we are to be here in the United States of America and the opportunities that we have in those places, because truly because of the greed. And I'm not saying we don't see that around us here in the United States, but the greed of the people that control those countries limits the opportunities that people have. And so they're doing the best they can. But the principle of economic security is relevant no matter what the circumstances are. For some of those people, it might be, where is tomorrow's meal and how am I going to get it? Do they have a game plan for it? How am I going to provide for these children that we have? So it's just a different scale for them given the circumstances that we have. And the same principle applies here in the United States. We just have a lot more abundance.
And we have a little bit more runway in the event of a crisis that I would think, because I lived in the Philippines during the mission I served for the LDS Church, and it was very much hand to mouth. I mean, you didn't go to the grocery store for a week's worth of groceries. You went for that day. Sometimes our house help would go twice a day.
Sure.
So yeah, we do have a bit more of a runway here in the
A
U.S.
lot more safety nets here.
Yeah, definitely. So you have run successful businesses before entering financial planning. Were there lessons from entrepreneurship to inform you in your approach to helping clients prepare for uncertain times?
Yeah, certainly. Of course, I grew up in a family business. With my parents and my grandparents, we all worked for the family business. So that was just in my blood to be an entrepreneur. And it's interesting. We're talking a little bit about tariffs today and some of these things that are on the news. And believe it or not, that's really kind of what eliminated my family business that I grew up in was tariffs. The big part of our business was the cattle business, and the Canadian government had tariffs on us being able to ship our cattle into Canada. But yet we had no tariffs on them. And so they would flood the market here in the United States with their livestock and bring the supply went up and the prices went down, which made, the American farmer that would, feed these livestock not even have a chance of being successful in doing that. And the government, unfortunately, didn't do anything about it. And eventually, I remember my grandfather saying, Kim, you should not be in this business. You need to find something different to do. The future for this business is not what it was for me when I was your age. And a lot of that had to do with the carpet being yanked out from underneath us by government entities that were out of our control. I had no control over those tariffs, and it really devastated our family business. And so am I for tariffs? Yes, but it should be a fair level playing field. And so we see other things that impact us, especially in the financial world, that are government regulation and things that they want to do. And so that I'm always on the lookout for when's that carpet going to be yanked out from underneath me. And I've had that happen as e-commerce. I was in the e-commerce business in the 90s, back when Jeff Bezos was starting his business. I was starting mine, and I saw that evolution and the writing on the wall of some of the things that were happening, and really made a decision like that's not really the space I want to be in. The way I started it and the way it ended wasn't the same. And a lot of that had to do with different regulations. And it's just an evolution that happened. And I chose to exit, sell my businesses, and get into something that I could be passionate about, which is assisting people with their finances and their wealth and making sure that they're safe.
Well, and you've clearly done a great job at that. I mean, here you are in a small town in Ohio. I mean, it's not the smallest of towns, but still. small town of Ohio, and you are in the top 2% of financial and wealth planning firms in the US. I mean, when you think about the names that you're going up against, that's a really impressive track record. Um, I I think that some of the things that you look out for are going to be very interesting tell signs for our audience. So let's just start there for our listeners, just starting their preparedness journey. What are the
Mhm.
most critical first steps for financial preparedness that often get overlooked?
Well, I think there's several things, and it depends on the stage of life that you're in, right? I mean, what is the one thing that a younger person has that an older person doesn't have quite as much of?
Time.
Time, right? They
Yeah.
don't have as much time. And the market goes up and the market goes down. And, if we don't have enough time to make our old money back, we're going to be in a whole heap of trouble. So the advice that I give to somebody who's, say, in their 20s or 30s that are working on building a portfolio, they have other variables at play, whether that's a mortgage or children, and they're really getting started on life. But the key component, and I think something that so many young people don't understand is do something. Whether that's put away $20 a month, or 10% of your paycheck, and put that into savings or for a rainy day fund. Um, Most of Americans, the vast majority of the wealth that they will have during their retirement years is accumulated between the ages of 50 to 65. That's just the facts. Prior to that, there's so many other pulls in on our income, on our savings. But 50 to 65, the kids have left home, colleges are paid for, and that's really when the funds start piling up in the savings account. And that's really the critical time that I'm focused on in helping people. Not that I don't help younger people, I do, but it's a lot different being able to help people with $500 versus somebody who, say, has a 401k with half a million in it or more. So I try to assist those that I say have won the game. Think of it like this: if you're playing football and you're on the 2 yard line with 20 seconds left in the game, and you're a touchdown ahead of your opposing team, what are most coaches going to do? A lot of us say, well, let's run the ball in and let's score another touchdown because we like touchdowns. But the best coaches take a knee. Why do they take a knee? The reason they take a knee is because they won the game. And I see way too many Americans who are in their late 50s or even retired who are still trying to score a touchdown when they've won the game. Now, I'm not saying we shouldn't try to grow our portfolio, but why are so many people taking risks way above and beyond what they should? You've won the game, for goodness sakes. Live your life. 1/3 of our lives will be lived in years when we no longer work. And that's going to require a lot of money. Why would we gamble losing the game at that stage of life if we've already won?
Yeah. Yeah, it's just for our listeners' benefit. I think it's funny that you used a football analogy, given how much you love OSU football. Don't you have like a whole room that's decorated in scarlet and gray?
Absolutely. Now I got to make more room for national championship gear. You bet. Yes.
All right, well, that's great. Okay, so let me make sure we're functioning on the same wavelength here. How do you define financial preparedness differently than mainstream financial planning?
Well, I think, as a prepper, as a person who believes in preparedness, we have to have our core foundation of our financial wealth. And that really boils down to a simple rule, a rule that I call the rule of 100. And in the rule of 100, it simply says whatever your age is, that percentage of your portfolio should be in a place where you can never lose money. I'm 53 years old. That means that 53% of my portfolio should be in a place where it can never lose, no matter what happens in the market. Now, I'm a little bit more conservative than that because of what I do, and I know what I'm doing. So, but too often I meet 60, 70, 80-year olds who are doing the opposite. They might have 20% of their portfolio in safety and 80% at risk. And there's a reason for that, because the advisors who are assisting them are want to keep that money at risk because that's how they get paid. I believe that we should be putting at least an equal percentage to our age of our portfolio in a place where it can never ever lose.
Well, I think it's interesting to note too. I know enough about your business that when you help customers with your financial vehicle of choice, they don't pay you a dime. Um,
Correct.
it doesn't come out of their money. You get paid, obviously, but you do not get paid out of their money, which
That's
is
correct.
fascinating. And it enables people to trust you better in your advice and in your strategies.
Yeah, I always tell people, listen, I do get paid. I make
Yeah,
money.
of course.
I just don't get paid out of your money. Okay.
Yeah, yeah.
And they always ask me, well, how do you do that? How is that even possible? Now I always simplify it and I say, listen, I get paid the same way your banker does. When we go and deposit money at the bank, I mean, do you realize they don't have a stack of cash back in the vault with your name on it? I mean, behind the scenes, they're loaning that money out for cars and homes for other people, and the bank is making some money off of your money. In a similar fashion, on our safe money investments that we offer, which are insured investments actually, where it's a dollar for dollar protected by insurance companies that have been around, many of them over 100 years. And those companies, obviously behind the scenes, are making a little bit of money off of the money that they're holding. They hold billions of dollars of
Hmm.
other people's money. If they make a few tenths of a percent on billions of dollars that don't even belong to them year in and year out, and they have a great track record of doing this, that's how they got big. That's how they got strong. And so they pay me out of their profits, not out of your money. And
Yeah.
that's just comforting to people to know that the only way their account balance can go down in these type of investments is if they take money out to spend, which is what I hope they do. That's what it's there for.
Yeah, absolutely. That's a fresh take on so many. I have a hard time believing that people are putting so much of their money in risk. I mean, did they not live through 2007, 2008, 2009? I mean, we lost trillions of dollars of 401k wealth during that period of time, and it was because people had their money in risk ventures, is what I meant to say. So let's talk about the vehicle of choice that you use often. It's not the only
Mhm.
strategy that you use, and we'll talk about that, but it is definitely one of your key strategies, and that's fixed income annuities. So
Yes.
what's the perception that people have about fixed income annuities that we need to correct?
Yeah. Well, there's a lot of different kinds of annuities out there. And I think, 10 years, 20 years ago, annuities kind of got a bad rap. And rightfully so, because a lot of the annuities out there were designed so that you could purchase a pension with them. A lot of pension plans are backed by annuities, for example. The problem with the old style annuities is that, if somebody died prematurely, the pension plan got to keep the money, and it didn't go on to your beneficiaries. That's not the way they work nowadays. So think of an annuity as simply a chassis. It's a type of a financial product that's offered through the insurance companies. There's insurance companies that specialize in these, that's all they do. So I'm really picky about the companies I work with. First of all, I want them to be A-rated, some of the strongest in the world. I want to make sure that they're companies that specialize in this particular product. I mean, there's a lot of great companies out there. I use, for example, a big company to insure my cars and my homes and things like that, but I would never use them for an annuity because they have a huge risk on the property and casualty side that I don't want them to pass on to me if there happens to be, say, a fire in California or a hurricane in Florida. I don't want that to impact my investments. And so I'm going to choose an insurance company that offers these products that don't have exposure to those markets, and that's what I work with. So the specific type of annuity that we work with is called a fixed indexed annuity. So think of it this way. I'll simplify it. Let's say you walk into your bank and you say, Mr. Banker, I love the concept of a CD. I like getting paid interest on my money. I have some money I want to put in the bank. I just don't like how much interest you're willing to offer me. How about if we do this? could you just simply peg my interest rate to an index, a stock market index like the S&P 500, the Dow Jones, the PIMCO, there's a variety of them. Let's peg it to that. And if the index goes up, you pay me interest on my money. But if the index goes down, I'm okay with my money just staying the same. Maybe I don't make a dime, right? I'm willing to take that risk. But in order to get a higher interest rate, I would rather my interest rate be pegged to one of those indexes. I don't want my money in the index. I just want you to pay me interest based on that index. Well, what's the banker going to say? You're crazy. There's no way I'm doing that. No, that's not the way this program works. But that's exactly the way a fixed indexed annuity works. We get to choose, you get to choose which indexes we use. And if those indexes go up, you make money. If the indexes go down or fall below that level, you don't lose a single penny. Your money just simply stays the same, waiting for that next year to come around. And if the index goes up again, you start making money. So it has an annual reset where the interest is dumped in, and then it's just off to the races again. But that's exactly how fixed indexed annuity work. Many of them today come with a lot of additional features that they didn't used to, such as guaranteed income that you can never outlive. And I tell my clients all the time, part of the goal here is to use the income. So many people struggle going into retirement because the reason they have money is at some point in their life, they figured out how to live below their means. And that's key. If I could say to anybody who's still working, who's younger, you have to figure out how to live below your means. That allows you to save. Well, some people figure it out sooner in life. Some people figure it out later in life, but I've yet to have anybody walk through my doors and open up anything with me that hasn't figured it out. Okay. But the problem I see is as they go into retirement, in those retirement years, is they continue to live below their means. And we have to change our psychology when it comes to retirement. When we get into those retirement years, we need to live up to our privilege. And I know privilege is a naughty word today in our country, but too many people continue to live far below their means in retirement. And the reason they do is because they don't even know what their privilege is. And that's the difference between financial planning and wealth planning. If you have a roadmap saying, listen, I can spend this much money and still not run out of money. I can spend this much money and still pass money on to the family as a legacy, or I need to throttle back my lifestyle. If you had the ability to peer into that crystal ball and know exactly what those numbers are, would that help people? That's exactly what we do. And so I've had many meetings with people who've come in and we go through that wealth planning session and they're like, what? I can go on vacation and what? I can drive a new car instead of my beater that I pulled up in? Absolutely. And I think Americans today of, say, my generation or ones that are retiring right now often feel a little different about their retirement goals. My grandparents were bent on leaving a legacy behind. They wanted to leave wealth behind to their family. That was important. They grew up in that era of the Great Depression. They realized as a young person what it was to not have anything. Today, most people feel passionate about, well, my kids will get the leftovers. I mean, I even feel this way. My wife and I are not going to sacrifice our lifestyle. We're still going to take the Jeeps out. We're still going to do the fun things that we want to do, but not at the expense of leaving this huge pile of money behind to our kids. If the leftovers are $5 or $500,000, then so be it. They're going to get the leftovers. And I think a lot of Americans today feel that way, but they don't understand what is within their privilege. And so that's important. We can't just invest and not know how much we can spend. And so not only do I help people preserve their wealth, I help them spend their wealth. And that's a key element when you're looking for a financial advisor who can show you that roadmap.
Well, to even have wealth to spend, obviously, that roadmap is invaluable. Okay, so we talked about fixed index. Let's talk about some of your other things that you wave your magic wand and accomplish.
Well, because the preparedness guy in me kind of I go off on tangents sometimes with my clients and preach to them some messages. Like, for example, I brought here with me a jar of some of the stuff that I've put together. This is actually a quart jar of freeze-dried eggs. These are
So
raw
that's
eggs.
worth a small fortune.
Exactly. This is I think about 2 dozen eggs in there. But obviously I made an investment in a freeze dryer so that I could create this stuff. Right now, these I made back in 2021. They last a long, long time. We use them at home. I use them camping. They're great. But is this wealth? Sure it is. When I have, a pantry, an area in my house that holds enough food for me and my family to go well beyond a year. Again, it's like anything that's our base supply, that year supply, right? That's not the most that we can do. What else should we do? I see mistakes that people make in preparedness where they just go out and buy the buckets of food storage at Costco or online or whatever. I mean, do you really want to eat au gratin potatoes for a year? So, I think you should prepare with the food that you like, that your family's going to eat. And so this is a whole nother topic, but that's wealth. That is having the freedom to do some of those things that you need. We can talk about even something like precious metals. I believe that precious metals is a great place to store wealth. It's probably not the greatest source of growing your investment portfolio, but it's an alternative to the greenbacks, right? I have some cash laying at home. We all should probably have some folded up in our pocket, but we should have other things that we keep money in. Is this worth something? Is this worth something? Absolutely. Which one's worth more is debatable, right? But we got to be careful. Some people go over the top on some of these things where I see them buying closets full of this stuff. Keep in mind, if there's a collapse of society, you're not going to be able to eat this. If there were a true collapse of society, this is going to carry very, very little value. It would take establishment of a normalcy for this to come back into value. But I recently bought some of this. This is gold, right? These are gram bars. They're size of an SD card. Is it worth having a variety of things to store our wealth in? Absolutely. Now, I bought this, let's see, 2 weeks ago. Guess where I bought it? At Costco. Costco sells precious metals.
Yeah, Costco sells that. In fact, I read an article on just how much of that they sell every month, and it's astounding.
Oh, yeah. Yep. I bought this one at Costco. Each one of these bars is basically $100 bill. They're gram bars. And I bought it online at Costco, and they shipped it right to my home, free shipping, no sales tax. And the inventory changes all the time. The cool thing is they sell it at spot, so you're buying it at a good price. But again, like anything,
now explain to people what spot is, because some people don't have experience buying precious metals.
Mm-hmm. So, if you go into, say, a gold dealer or a coin dealer, they're going to sell you, this is a 10-ounce bar. They're going to sell you this with a little bit of a markup. So spot would say this is worth $32 an ounce. If you walk into the store, they're going to sell it to you for $34, $35 an ounce. And of course, we shouldn't begrudge them for that because they have a business to run. How does Costco sell it at spot? I don't know. They're just, I don't really care. and then I get I use my Costco card to get some money back, right? So it's pretty hard to beat. I feel for the coin dealers that are competing with them, but this is one of those things of the evolution of money, of how things are changing. But spot, even if I go in to sell it, if I take this into a coin dealer or a gold dealer, they're going to give me about $30 an ounce, even though I have 32 in it, let's say. They're going to pay me less than spot because they have to make money on it. No different than a pawn shop. They're going to buy something from you, but then they're going to sell it for more. That's the principle of being in business. Any business who doesn't plan on making a profit will be out of business quickly.
So let me ask you this. What kind of, beyond traditional market risks, what financial threats does Kim prepare for?
Well, I think that we have to be prepared to move our assets when the timing is right. Right now, I love a lot of what I see happening in the current administration, but it brings with it some challenges, some volatility, the way the market's reacting to some of these things. So there's times when it's appropriate. We have to, pull and sit on the sidelines or sit in safer instruments. We have to be careful with how much money we keep in banks nowadays. Banks are very, very much insolvent. They are not required to carry hardly any capital for the deposits that you have. Whereas, say, a company that does fixed indexed annuities, they have to have a dollar for dollar match to every dollar that they hold for somebody. So if I have $100,000 on deposit with a particular company, they are required by law to have $100,000 in their capital account to match that. So I like that versus my bank that is required to have less than 5%. In fact, during COVID, the Biden administration said, banks, you don't have to have any reserve. Now, a lot of people feel a sense of comfort when they walk in their bank because they see that FDIC sign. And what does the I stand for? Well, it stands for insurance, is what it stands for, FDIC. But the F stands for the federal government. So here's the question: who insures the banks? The federal government does. How many of them do they insure? The answer is simple: all of them. Yeah. So if there were a run on the banks and the banks all started to fail, do we as American citizens truly believe that our government has enough money to make us whole? Well, here's what I would encourage. Go online, look up the FDIC rules. They actually have 7 years to give you back your money through that insurance program. How many of you can wait 7 years to get your bank money back? So again, do I use banks? Yes, that's how I pay my bills. But we should not be silly and keep all of our money in those places. Even if we look at the insurance industry, and one of the reasons that I love the fixed indexed annuity is because these companies have weathered every financial storm you can imagine. They're over 100 years old. That means they lived through the Great Depression. How is that possible? Well, even in a time of our country's histories in the 40s and 50s, when our country almost went broke, the government literally went to the insurance companies because the banks were broke, the stock market was broke, and they said, we need money. We have to stay solvent as a country. And they asked the insurance companies to give them money. And they said, we'll create these things called government bonds. You buy them from us and loan us money. And that's exactly what happened. The insurance industry actually bailed our country out. And one of the agreements that a lot of people are unaware of that happened with that is the insurance companies said, we want something in return. And the government said, well, what do you want? They said, we want you to keep life insurance tax-free. And to this very day, life insurance is tax-free. So I believe that a nice insurance product, in fact, just like annuities have evolved, so has life insurance. Back when I had life insurance, my parents bought it on me as a kid. That was actually called death insurance, would have been the appropriate name for it. It's simply, you only benefit when you die, and you actually don't benefit. It's the beneficiaries who do, right? Today, we have true life insurance where you can have a living benefit. So I put a lot of my wealth into tax-free instruments that are insured. They're riding the chassis of life insurance, but it's not for life insurance. Sure, if I die, my family will get some extra money, but that's not the primary reason. I have access, liquidity to the money. It's insured. I have these additional benefits for death or long-term care that are built in. And here's the cool thing about using cash value life insurance as a financial investment. It is not taxable to you, to your beneficiaries, to your estate. It stays out of probate. There is zero government reporting, no 1099s that happen. Even if you have money in another tax-free instrument called a Roth IRA, they are required, the financial institution, to notify the government every year how much money you have in there. Why does the government want to know how much money you have in a Roth if it's not taxable?
Yeah.
maybe I don't know, maybe they're thinking they want to change the rules at some point, right?
Yeah.
So
Yeah.
the only financial product that you can find that's actually insured dollar for dollar, no government reporting required whatsoever, passes on completely tax-free in every instance, you can use the money tax-free during your lifetime, is cash value life insurance.
Well, let me ask you this. For those who are just starting out, they're just starting to get their act together, and everybody starts somewhere. What's the minimum amount that they can initiate with someone like yourself?
So when it comes to, say, an annuity, those are going to have minimums of right around $20,000 to get started on something like that. And right now, many of the companies are being very aggressive, where they're giving prepaid interest on your money. An annuity comes with a time commitment. Basically, if I open up one of those, I'm going to say, listen, I'm going to make a time commitment to that insurance company for anywhere between 5 to 10 years. My advice, don't do anything longer than 10 years. There's no benefit to you. Okay.
Mhm.
But what we see on some of those longer, let's say the 10-year time commitment ones, a lot of companies are willing to give you prepaid interest on your money, often called or referred to as a bonus. And those bonuses, some of them are 50%. Can you imagine, Colleen, saying, hey, I've got $100,000 that I'm going to roll out of my 401k and I'm going to throw it into something, and the company actually gives you $50,000 day one, putting it in there, and all they want in exchange is your time commitment, saying, hey, if you're okay with only taking 10% out every year, we're going to give you 50% right up front.
Yeah.
I mean,
How could
who
you
does
not?
it? Your bank won't do that.
Yeah. Yeah, they're definitely better instruments. Well, let me ask you this. From a standpoint of helping clients balance liquidity needs with long-term financial security, what's your approach there?
Well, I think there's different demands for liquidity based on your age. Okay, if you're working, can we agree that your paycheck is part of your liquidity, right? I mean, that's coming in on a regular basis, and so it's different for somebody who's retired. And depending on your living circumstances, how much do you need to spend every month to pay the bills? What's your lifestyle? So liquidity will be based on that. I would venture to say that in my office, if you don't have access to a minimum of $40,000 to $50,000 that you can just go get your hands on, probably making long-term investments isn't going to be a good fit for you in something like annuities. I want to see you, because life throws emergencies at all of us. I want to see you be able to have access to the money with no time commitments. Immediately, within 2 weeks, I could get my hands on it. I mean, I could cash in this within hours if I wanted to. So that's liquid assets, right? My home is not liquid. Even though homes might sell quickly, I mean, I don't have any guarantee that I can just go sell my home and get my money out right away. So that's not a liquid asset. But I want to see them have access to probably a minimum of $50,000 before we consider making long-term investments. And it depends on what your asset, what your lifestyle. If you're gonna say, Kim, I need 15,000 a month to pay for my lifestyle, then great. We're gonna say you need at least $100,000 of liquidity.
Let's talk about a case study. A case study that where somebody started here and they ended up with this, because you've been doing this a long enough time that you can have some of those case studies. Share with us one of those fun case studies.
Okay, yeah. So I've had a lot of different ones. I think one of them that comes to mind is a couple that came to me several years ago. Pretty excited. They never knew that there was a way that they could protect their assets. And I truly believe that well, I don't just believe, I know many of the financial planning firms don't want people to know about safe money investments, and they prevent their advisors from telling people about it. I mean, I came from one of those where I would get fired if I told them about certain things. So that happens. That's very, very real with a lot of the brokerage firms out there. But they didn't know that there was a way that they could keep their money safe. They came on board. They were excited. They got some nice bonuses. Life was good. They had a really good income. Unfortunately, about a year and a half later, the husband was diagnosed with Lou Gehrig's disease. And few years later, he passed away. Um, so I remember meeting with him, and he's like, Kim, I really want you to take care of my wife, make sure she's financially stable while I'm gone. And I assured him that we would do that. And he left her sitting in a pretty good position. But she's a disinterested spouse, meaning she didn't really handle the money. He handled all the money, and he wanted something where she could have a guaranteed income, because he knew that when he died, some of the income would go away. Some of, like, her Social Security disappeared, but she got to keep his. Some of the pensions disappeared, so she needed additional income. And thank goodness for the fixed indexed annuities, because she's able to have that guaranteed income to maintain her lifestyle. In fact, she recently decided to build a new house, to move to something more appropriate for her age. She's having a little trouble getting around. I got a phone call one day. She was sitting at a bank, and they wanted to put her in can you believe this, Kelly, a 30-year mortgage, and she's in her late 70s. I'm like, in what world does that make sense? And I think it was like 8.5% interest on this mortgage, maybe even higher. And I remember saying, Kay, there's no point in doing that. You have the funds. Let's just cash some money out and buy the house. And she's like, what? I can do that? I'm like, yes, Bob left you sitting in a great place. If you want a new house, you just have to say so. Well, the mortgage people weren't too happy about that. And so needless to say, she came into my office. We liquidated some of her funds that she has here, and she's now enjoying her home and still has guaranteed income. She's got these accounts come with long-term care benefits for her. So yeah, she has nothing to worry about.
All right, let me ask you, I only have a few more minutes left, so I want to make sure I get some of these questions in. And maybe you've already shared it, but let's just leave room for there being more great Kim ideas. What's one financial preparedness step that almost every prepper should take, but most of them haven't?
Well, I think probably first of all, as a prepper, you need to invest in the things that will help you survive uncertainty. Okay. So again, things like food storage, that's common sense. I believe that that's more important even than money in the bank. Now, I'm not saying that you shouldn't have any money in the bank. Don't go broke to buy a freeze dryer and start your food. But everybody should buy an extra can of beans, right, or an extra whatever they can, and start accumulating. People who are not prepper friends or not in the preparedness community sometimes will come over to my house and they'll see my supply and they're like, oh, you must be one of these fanatics. No, I'm realistic. I mean, keep in mind, we just live in a day and age in our country when most of the people alive today have not experienced a situation where they've had to depend on their food reserves. So common sense tells me I need to have a way that I can at least feed myself and my family, right? So number one, make sure you take care of the core basics to survive: food, water, self-defense, and knowledge, right? I still buy books. I know everybody's like, oh, I can get that on my Kindle. I like paper books. Yeah, as you described. In an EMP situation, is my Kindle going to work? Probably not, So I want to have resources, a library of knowledge, because do I need to know how to pull somebody's tooth? Not today, I don't. But do I want, if I in a down grid situation, do I want to know? Yeah. But so invest in that. Okay. That's a good base. If you haven't done that, at least do that. Okay. Then of course, keep some cash on hand. Keep it in a safe place. There's a very good likelihood that if things start falling apart, we saw this recently with the Silicon Valley banks where the doors were closed. Imagine waking up and you need to go to the bank and get some money out to pay some bills or whatever, or that you can't even log on to your app on your phone, and it's like the system's down right now because the banks are going through a situation of turmoil. They're going to shut that down. What are you going to do to survive those maybe few days, weeks, or whatever it is, like people in Greece had to do, or other places? Have some cash on hand. That's common sense. Have some other reserves, some precious metals. It's not a bad thing. Go in, save some. An ounce of silver is $32 today. I mean, $32. Go buy an ounce. Start with an ounce. And I believe in bullion rather than numismatic. In a grid down situation, that collectible, quarter from 1921 is only going to be worth the value of the silver in it. So buy bullion is my advice. And then ultimately, for preparing for the rest of our lives, save in a place where you can't lose. If you want to gamble with some of your money, now I invest in the stock market. I own cryptocurrency too, but I look at the stock market as a Wall Street casino. And I'm only going to invest with what I'm willing to lose. If you're not willing to lose your money, if you wouldn't walk into a casino and put it in the slot machine, don't invest it in the stock market. Okay. And until you get to the point where you're like, hey, here's an extra $1,000 that I can afford to risk. Okay, great. Go online, open up a Robinhood, get started with that. And then it will grow. But save. If you don't figure out how to live below your means, you'll never get there. You'll never get there. Get out of debt. Debt is the noose hanging around Americans' heads right now. We get rid of the credit cards, pay them off. Do not have debt. You don't want to be beholden to those people. They will not help you. Pay off your mortgages, pay off your credit. Some people say, well, it's cheap. I got my mortgage at 2% and I can't borrow. Don't borrow. Pay it off. Become a free person. Okay. In a free people, truly free people don't owe anybody anything. Okay. You want to get there. It takes time, but you got to start doing it.
Wonderful. That's wonderful words. Well, I want to make sure that everyone can come to you for advice. So let's make sure that they know how to get in touch with you, Kim. Why don't you share your details with us?
Sure. You can call my office. My office number is 888-665-7229. And I'm happy to, have a conversation with you. I can do a Zoom call, whatever works for you. You can go to my website and learn a lot more about what I'm talking about. That's legacygroupplanning.info, INFO. Again, legacygroupplanning.info will take you there. And there's some videos you can watch about what we do. We do a lot of educational seminars in this area, Northwest Ohio, Southeast Michigan. Even if you want to meet with an advisor who's on the same wavelength as what I am, there's about 300 of us nationwide. And I can connect you with somebody in your area if that's what you want to do.
But you're also licensed in all 50 states, though, too, correct?
Absolutely. Sure.
Yeah.
Yeah, so I can help anybody anywhere.
That's wonderful. Well, Kim, thank you so much for your precious time. I appreciate it. I know how busy you are, and I'm very grateful for the time that we had this morning and the enlightenment, the interesting details that you gave us. And I wish you the very best.
Thank you, Colleen. Same to you. Thank you for having me on board.
Thank you so much.
All right.